Right. Today we're going to talk about the automated underwriting system. What in the world is AUS? So the automated underwriting system is a computerized software that it's a system that's used in the mortgage industry to evaluate and make decisions on loan applications. And basically it streamlines the underwriting process by using algorithms and predefined rules that are set by the agencies to analyze any potential home buyer or borrower's financial information to determine the level of risk associated with approving the loan. So the AUS considers various factors when assessing a loan application, and these factors will typically include things like your credit history. So it's going to look at the credit report and all the details that are in the credit report, such as the score, payment history, outstanding debts, and if there's been any kind of previous bankruptcy, foreclosures, things like that. It also is going to look at things like your income and employment. So what's the stability of the employment? How much income do you have? What's the type of income, length of employment, things like that, consistency. So it's also going to look at the debt to income ratio. So the debt to income ratio is looking at your monthly debt obligations, such as credit card payments, student loans, other car payments, things like that. And then it's going to look at your gross overall income. So it's basically looking at what's the ability to be able to manage and take on any additional debt. So it also looks at the loan to value, or LTV as we call it for short in the mortgage industry. So it's looking at how much basically you're putting down. Is your down payment the minimum? Are you putting down more than the minimum? So it's taking that into consideration. So it's also going to look at what is the property type. Some property types have different levels of risk associated with it, such as a single family home versus a manufactured home versus a multi-unit property or a condo, things like that. So, it's just looking at basically overall, what are the rules that have been set forth by the agencies such as Fannie Mae, Freddie Mac, VA, HUD, etc. And basically just it's generating an underwriting decision, and that's indicating basically whether the loan should be approved, denied, or basically flagged for further review. So the automated underwriting process enables the loan processing to be more efficient, happen faster, and reduces human error and improves basically just overall efficiency in the underwriting process. So now that we know what the AUS is, why would an automated underwriting system not approve someone? So there are several reasons why the system may not approve someone. And so some of the common reasons would be something like the credit score is out of range, or another reason would be maybe we just don't have sufficient income to take on that new mortgage payment in addition to the existing liabilities that we have. A lot of the times it's also because of poor credit history, the way that debt and things have been managed in the past. So a history of late payments, a one-off late payment here and there isn't typically going to throw the AUS into a denial. But if there's been a pattern of frequent late payments or things that have gone into a default, such as collections or charge-off or bankruptcies, foreclosures, all those things can negatively affect the automated underwriting system. So it's going to take all those things into account. Also, something that a high debt to income ratio, if it's if there, and also if there's a combination of these things, if we have a high debt to income ratio, if we also have issues in the credit history, or we have something else is a lack of reserves, and so that's one that people don't often think of. So the reserves is looking at basically how many months of mortgage payments do we have left after closing, after what's needed for closing costs and down payment and all of that. What are the total assets left, and how many payments does that equate to? Do we have any months of payments left? Do we have 1, 3, 6? So it's going to be taking into consideration the reserves. And so the reserves basically is something that really is looked at as a strength, because it's just demonstrating a borrower's ability to handle any kind of unforeseen financial challenges or burdens, and be able to continue to make that mortgage payment and not go into default on that mortgage. So the last reason that the automated underwriting system could potentially not approve a loan is because of maybe there's something inaccurate, or maybe there's something incomplete on the mortgage application that we need to fix. So always make sure to have a a very thorough look at the application to make sure we have the correct employment history, we're not missing any bank accounts, things like that. So the next thing is, in the event where the automated underwriting system it does play a significant role in the decision-making process in the mortgage industry. But in the event that the automated underwriting system does not approve a loan, then the next thing we could look at is maybe doing a manual underwrite of a loan where it is a human that looks at it. So what's the difference between a manual and an automated underwriting decision? So the main difference is basically the level of human involvement and decision making in that underwriting process. So we've already gone over what the automated underwriting does. It's a computer underwriting software, so it looks at all the data we've already put in and makes a decision. Now with the manual underwriting, it's looking at basically it's a human has to evaluate the debt to income ratio and evaluate the credit history and compare it with the guidelines that are established. And there is some discretion, but basically the credit worthiness has to be determined by a human. And so oftentimes when we go through the manual underwriting process, additional documentation is required because there are additional rules on top of the standard rules. Things like, with an automated underwriting system decision, a lot of times we don't have to do a verification of rent. Sometimes that can help. But, in a manual underwrite, a lot of times we do have to verify rent. And so sometimes reserves are required when we go manual underwrite. So there are some decisions and requirements. But basically, a case has to be prepared and presented to a human underwriter for them to make that final determination. So it is worth noting that, we as lenders will use a combination of automatic and manual underwriting, but the automated underwriting software is typically the path of least resistance because it does take that human decision out of the equation as long as the data that's being submitted to it is correct. There's a couple of things I also want to touch on. So in the event where the automated underwriting system is not approving a loan or a profile that we've submitted, and we've already cross-referenced the manual guidelines and we don't fit the criteria for that because of, something like we don't have the reserves, or it's not been long enough since the last late payment, or there's too many outstanding collections for whatever reason, maybe the debt to income ratio wouldn't fit into the manual guidelines. Then the next step is for us to look at what can we do to improve the risk profile so that the automated underwriting system will have a better chance at getting us that approval. So there are some things that we can do, such as, working on the credit, improving the credit score. We can also look at ways to make changes to the debt to income ratio. So maybe that's a matter of refinancing something, paying some debt off, or if we know that there's going to be a pay raise coming in the future, we can look at that, or maybe we add another person to the loan to help the overall debt to income ratio. Other things we can look at is maybe we look at putting a larger down payment. That can be a strength if we're putting more than the minimum down. So for example, if the minimum down payment is 3%, maybe we look at doing 5%, maybe we look at doing 10%. So, another thing also could be is, just looking at the reserves. I mentioned the reserves a little bit earlier. So if a profile is kind of on the cusp of being approved and not being approved, sometimes having just 1 month of reserve, 3 months of reserves, or 6 months of reserves, that can make the determination on whether or not it will approve the file. So, remember just basically that we look at, a lot of people think that me as a mortgage originator, that I am the one who makes a decision, but my job is to think and understand that automated underwriting software so that I can help coach and plan for that with all of the borrowers and all of our clients that are out there. And so our goal is to help get you to that approval. And sometimes we just need to do a little bit more work than other times, but that is what we are here for, is to coach you and get you there. So if you have questions about the automated underwriting system or would like to talk about getting approved, just reach out. We'd love to help.